Alright, welcome back. Time to start the actual technical analysis. In this video, we're going to be talking about candles and support and resistance. We're going to be explaining candle structures, the types of candles, candle confirmation or closes, support levels, resistance levels, and spotting reversals in an asset. Now, what are candles? Candles are a way to visualize the price action of an asset through specific time periods. If you see this chart in the upper right hand corner, that is a line chart, but if you see this chart on the bottom, that's a candle chart. Now, why would you use a candle chart? Well, because it just gives you more information. They're both displaying where the price is moving over time, but here you see a lot more than just a line. So let me explain that. For example, let's use a 1 hour candle. So you can pick any time frame you want, but just for the sake of this video, we have two candles right here, a green candle and a red one. Both candles show the lowest point of that hour, the opening point of that hour, the closing point of that hour, and the highest point of that hour. Now, if within that hour the price closed higher than it opened, it's going to be a green candle. If it closed lower than it opened, it's going to be a red candle. So this is just how you can interpret, these candles. Pretty much 4 pieces of information on this candlestick. And let's get it going. Now, there's different types of candle signals. The two ones on the left and right sides are hammer candles. This one is a bullish candle, the green one. That pretty much means that you did go pretty low within that hour, but at the end of it, you ended up closing higher than you opened, right at the top. When you close that 1 hour candle, you were all the way at the top of the price point within that hour. On the other side, a bearish candle would be a shooting star, which pretty much signals that the price is going to potentially start going downwards after this candle, and it pretty much means that you closed at the lowest point of the hour. Some Japanese candlesticks are the neutral doji, which basically has no candle body, which means you open and close at the same price and you didn't move too much. So not too much indication from that. You have the dragonfly doji, which means you opened and closed at the same price, but that price was much higher than your lowest point within that candle hour. You have the gravestone doji, which is a bearish candle, pretty much means that you open and close at the same price, but within that hour you went really high in price but were not able to sustain those prices. Then you have the long-legged doji candle, which is also kind of neutral, but since you went really high up and really far down within that hour, it could signal an increase in volatility in the near future, which means the price could potentially be moving up and down a lot more. Moving on, candle confirmation is very important. You want to be using higher time frame charts, such as, there's different combos. A lot of people use the 1 hour and 4 hour. Personally, I use the 4 hour and daily charts. But basically, the more time you're putting into those charts, the more significant their signals are, which means that it displays more of what the market participants were doing within those candles or within that time period. So on your chart, if you're using TradingView, always want to use higher time frames for more validity. Also, you want to wait until a candle is completely painted before trying to identify it, because things can change. You can see a bullish hammer, but eventually you can turn that into a bearish engulfing candle. Actually, let me go back real quick. I didn't talk about the bearish and bullish engulfing candles. Basically, these are candles where they pretty much engulfed the previous candle. So imagine for this bearish candle, you had a smaller candle right here that was bullish, but in this bearish candle, you opened higher than that and closed way lower than that previous candle. And then the bullish engulfing candle is pretty much the opposite. The bullish candle closes above the previous candle's open, and the bullish candle opens at or lower than the previous candle's close. So I just had to cover that real quick. Just for some more example for confirmation, you always want to wait until the next candle is on your chart, at least the first minute of that candle, before referring to the previous one as guidance. So as I said at the bottom, wait until the second candle is on your chart before using this first candle as an indication. Moving on, we're going to be talking about support. You're going to hear this a lot if you watch different traders. A support level is basically a price where there is a good probability of bouncing back up and discontinuing a downtrend. These are key areas to recognize in order to maximize profits and not sell the bottom. This is where a lot of new traders end up selling, and then they regret that as they see the price going up right after. Now, how can you identify these support levels? One way is through his horizontal supports, which is basically past areas where you keep on bouncing off of a certain price, or it could even be a past resistance, which is called a support resistance flip. And we're going to be going into resistances next. Another way you can identify these is the bottom of whatever structure an asset is in. You're going to get a little bit more knowledge on this when we go over the charting video. And then another more advanced way to identify it is through Fibonacci, which will be much later in the course. Now, resistance is a level where there's a good probability of falling back down after hitting that target and discontinuing an uptrend. However, if a resistance is breached, which is called a breakout, there's a good chance you will see the price move up more. We're going to be talking more about breakouts later. You can't just simply, break that resistance and immediately expect to see the price, rally up, although sometimes it does. But I'm just going to give you some more information on that later in the course. Now, how can you find resistances? You can find them through horizontal resistances, such as past areas where you had, a resistance or a level where the price could not get higher than, or even past supports known as the support resistance flip. Another way you can identify resistance is by seeing the top of whatever structure an asset is in, which we will talk about more in the charting video. And then a more advanced level, again, is Fibonacci levels, which we will also talk about in a much later video. So here come the breakouts. A breakout is when an asset has confirmed it is going to enter new prices apart from the range it was in. Breakouts occur once a resistance or a support is reached. However, it is common to have backtests of the breakout levels, which pretty much means you go back to where that resistance or support was and you test it to try and get that support resistance split. This can be a safer place to enter rather than trying to buy the top of a breakout. It just gives you a little bit more potential to gain, or if you're noting a breakout where you breached under support, which is a bearish thing, it could give you a better chance to sell rather than selling the bottom of that breakout. Now, how do you confirm a breakout? You have to confirm it by seeing if the candle has closed over the resistance or under a support level. The volume of the breakout is also another significant way to tell. That pretty much means a lot of other traders are ready to enter new prices, whether that be up or down. And a more advanced thing, which we will talk about in the final video of this course, is oscillators. They can help give you guidance for possible breakouts. Now, how do you spot reversals? How do you see, if something is going up in price or going down in price? How do you see when it's going to stop going up or down? For swing traders especially, reversals are the key. You want to find the lowest point for an asset in the midterm or short term when you are buying it. And on the flip side, you want to know when to take profit if you are aiming to close your position. So if you want to enter something, you want to enter not at the high point, at the low point. And if you're trying to get out of a position, you want to get out at the highest point. So how do you spot these reversals? A confirmation of a breakout to the upside or downside. Remember, a breakout can be a positive or a bad thing. If you are, exiting a range to the upside, it's a good thing, and vice versa. Significant volume on candles or one time period shows that at an instant, a lot of traders were willing to buy or sell that asset, which is known as buyer hype or seller panic. Another way to spot a reversal is if you're approaching a horizontal support or resistance, which pretty much means either an area you keep on failing to break, which is a resistance, or an area which you keep on failing, or which you keep on bouncing off of, which is a support. Another two ways that are more advanced to spot reversals are Fibonacci retraces and oscillators, but we're going to be talking about that a little bit later in the course. But that pretty much wraps up this video on candles, supports, and resistances. If you have any questions, leave them down in the comments. Make sure to subscribe if you haven't already, and I'll see you in the next video. Thank you for watching.